When ratios that have defined entire monetary eras begin to fracture, it is never noise, it is a signal. And right now, the gold to silver ratio is not just moving, it is compressing toward levels that most investors have never witnessed in their lifetime. This is not a prediction whispered in the dark. It is a structural shift forming in plain sight, where history, mathematics, and monetary pressure begin to converge into a single outcome. And that outcome is volatility, repricing, and a full reset of perception around real money. In this moment, you are not looking at a normal market cycle. You are looking at a ratio that is being pulled apart by forces larger than sentiment, forces tied to scarcity, industrial demand, and the long arc of monetary imbalance. And what comes next is not gradual, it is compression, it is acceleration, it is recognition. When we talk about the gold to silver ratio, we are not talking about a simple market indicator that moves up and down like a routine oscillator on a trading screen. We are talking about something far deeper embedded in the history of money itself, something that has survived empires, currency collapses, monetary reforms, and industrial revolutions. And what we are witnessing right now is not just another fluctuation inside that long timeline, but the beginning of a structural breakdown that is challenging the very framework that has held this ratio in place for decades under modern financial engineering for most of recorded history. Gold and silver have not just been metals, they have been the foundation of monetary trust, and the ratio between them has acted like a silent agreement between scarcity and utility, between store of value and medium of exchange. And when that agreement begins to distort beyond historical norms, it is never because of a single factor. It is always because multiple systems are bending at the same time. And what makes the current environment different is that the bending is no longer subtle. It is becoming visible across multiple layers of the global financial structure. In earlier eras, the ratio would expand and contract based on mining discoveries, on wars, on monetary debasements, and on technological shifts, but even in those periods the movement was still anchored by physical reality, by the fact that both metals were actively circulating in commerce, or at least directly tied to currency systems, whereas in the modern era the ratio has been increasingly shaped by paper, derivatives, leveraged contracts, and financial abstractions that often have little to do with the actual physical availability of silver or gold in the real world. This is where the first major distinction appears between a normal cyclical movement and what we are now observing as structural breakdown. Because a cycle implies repetition within stable boundaries, while a breakdown implies that the boundaries themselves are no longer holding, and when those boundaries fail, the ratio is no longer behaving like a pendulum returning to equilibrium. It starts behaving like a compressed spring being released unevenly under external pressure. The modern gold to silver ratio has been allowed to drift into extreme territory in large part because of financial suppression mechanisms that operate through futures markets and large institutional positioning. And over time, this has created a disconnect between the price discovery mechanism and the physical market reality, especially for silver, which has a much smaller above ground stock relative to demand than gold, and is also consumed industrially in ways that permanently remove it from circulation. What makes this divergence critical is not just that silver is undervalued in relative terms, but that the structure holding this undervaluation in place depends on continuous liquidity, continuous confidence, and continuous willingness of market participants to accept paper pricing as a substitute for physical settlement. And once any one of those three pillars begins to weaken, the ratio does not adjust gradually, it begins to gap, it begins to leap, and it begins to reprice in a manner that looks chaotic from the outside, but is actually a reflection of delayed equilibrium restoration. When we say structural breakdown, we are referring to the moment where historical reference points stop functioning as reliable guides, because in the past, even extreme ratio levels would eventually revert due to natural arbitrage forces, miners responding to price incentives, industrial users adjusting consumption patterns, and investors rotating capital between the two metals. But in the current environment, those feedback loops are distorted by financialization, meaning the normal self-correcting mechanisms are weakened or delayed. Silver, in particular, sits at the center of this distortion because it is not just a monetary metal. It is also an industrial input in technologies that define modern economies, including electronics, solar infrastructure, medical applications, and advanced manufacturing. And this dual identity creates a situation where demand is not purely speculative or investment driven but structurally embedded in global production systems, which means that when supply tightens, the impact is not confined to price charts but extends into physical availability and allocation stress. At the same time, gold continues to function primarily as a monetary reserve asset, concentrated in central bank holdings, sovereign reserves, and long-term wealth storage, which gives it a different demand profile and a different sensitivity to macroeconomic conditions. And when you combine these two metals into a ratio, you are effectively comparing two different demand universes that are now diverging in behavior rather than converging historically. The ratio has moved in wide arcs, from single-digit levels in ancient monetary systems to much higher levels in modern financial markets. But what is important is not just the magnitude of those swings, but the context in which they occurred, because in earlier systems the metals were directly interchangeable in commerce, whereas today they are separated by layers of financial instruments that delay the transmission of real-world scarcity into price discovery. The concept of structural breakdown emerges when that delay becomes so large that the correction required to restore equilibrium is no longer incremental but exponential, meaning that instead of gradually drifting back toward a historical mean, the ratio overshoots in the opposite direction once the suppression or imbalance becomes unsustainable. And this overshooting is what often catches markets off guard because it does not respect conventional pacing or investor expectations. Another critical element in this breakdown is the role of perception, because markets are not only driven by supply and demand, but also by belief systems. And for a long time, the belief has been that silver is simply a secondary metal to gold, a smaller version of the same monetary concept. But as industrial dependency increases and physical tightness becomes more apparent, that perception begins to erode. And once perception shifts, valuation frameworks shift with it in a nonlinear way. This is why the current phase is better described as a transition from stability illusion to reality exposure, where the illusion is not necessarily intentional manipulation alone, but a combination of market structure, leverage, and historical complacency that has allowed the ratio to drift further than it would in a physically settled system. And the exposure happens when external stress forces participants to reassess assumptions that were previously taken for granted. Mining economics also play a significant role in this breakdown, because silver is often produced as a byproduct of other metals such as copper, lead, and zinc, meaning that its supply does not respond cleanly to price signals, unlike purely primary commodities, and this creates a lag between rising demand and actual production response, which further intensifies scarcity conditions when demand accelerates unexpectedly. In addition, years of underinvestment in new silver exploration and production capacity have contributed to a situation where even if prices rise significantly, the time required to bring new supply online is not short enough to immediately stabilize the market, and this delay between price signal and supply response is one of the key ingredients in any structural market breakdown scenario. The gold to silver ratio, when viewed through this lens, becomes less of a static indicator and more of a pressure gauge inside a closed system. And what we are seeing now is that the pressure is building across multiple dimensions simultaneously: monetary uncertainty, industrial expansion, supply rigidity, and financial leverage, all interacting in a way that amplifies rather than dampens volatility. When such systems reach a critical point, they often do not transition smoothly. They transition in phases, where the first phase is disbelief, the second phase is adjustment, and the third phase is acceleration. And in the disbelief phase, most participants assume that historical norms will reassert themselves. In the adjustment phase, they begin to hedge exposure. And in the acceleration phase, they are forced to react rather than plan. It is in this acceleration phase that structural breakdown becomes visible to everyone, not just analysts or long-term observers, because price movement begins to detach from traditional valuation anchors, and the ratio can compress or expand rapidly as liquidity shifts between markets seeking safety or opportunity. And in the case of silver, The movement is often sharper due to its smaller market size relative to gold. What makes this entire situation even more sensitive is the increasing interconnectedness of global financial systems, where capital can move across asset classes almost instantly, meaning that once a narrative shift begins, it can propagate much faster than in previous decades, amplifying both upside and downside moves in a way that reflects not just fundamental revaluation, but also reflexive behavior among participants in this environment. Describing the gold to silver ratio as merely high or low becomes insufficient because those terms assume stability in the underlying structure, whereas what is actually unfolding is a transition in structure itself, where historical reference ranges are being challenged by new conditions that did not exist in previous cycles at the same scale or complexity. And as this process continues, the distinction between paper price and physical reality becomes increasingly important because structural breakdowns are often characterized by a widening gap between what is quoted in markets and what is actually available for delivery. And silver, due to its smaller market size and higher industrial consumption, is particularly sensitive to this divergence. At the same time, investor awareness tends to lag behind structural change, meaning that even as conditions evolve, many participants continue to rely on outdated frameworks, which further delays adjustment and increases the eventual magnitude of repricing when awareness finally catches up to reality. What is forming now is not just a statistical anomaly, but a multi-layered convergence of monetary history, industrial demand pressure, supply rigidity, and financial abstraction, and when these forces align, the resulting movement in the ratio is no longer smooth or predictable in the traditional sense. It becomes a reflection of a system trying to reprice itself under conditions where the old equilibrium no longer functions as a stable reference point anymore. Silver occupies a position in the global monetary and industrial system that no other asset fully replicates. And this dual identity is precisely where the pressure is building most intensely in the current environment, because when a single commodity is asked to serve two fundamentally different masters at the same time, the stress does not distribute evenly, it concentrates, and when it concentrates long enough without structural relief, it eventually expresses itself through price dislocation that appears sudden only to those who were not observing the underlying compression. On one side of silver's identity, it functions as a monetary metal, a store of value that has historically been used alongside gold to represent wealth outside of fiat systems, and on the other side it functions as an industrial necessity, a consumable input in modern technology that is not simply stored but transformed, embedded, and permanently removed from the above ground supply pool. And this distinction alone creates a fundamental imbalance because monetary metals are typically expected to remain in circulation or vault storage, while industrial inputs are expected to be consumed and depleted over time. When silver was used in coinage systems, its monetary role and its physical circulation were aligned, meaning that even though it was both consumed and stored, there was still a consistent feedback loop between availability and demand. But in the modern era, that loop has been fractured because monetary demand is now expressed through investment vehicles, ETFs, futures contracts, and digital claims, while industrial demand is expressed through irreversible physical consumption and manufacturing processes that include solar panels, electronics, medical devices, and advanced energy systems. This separation between paper demand and physical demand is not just a technical detail, it is the foundation of the current pressure dynamic because the paper market can expand supply of claims without immediately affecting physical inventories, while the industrial market steadily drains physical stock regardless of price signals. And when these two systems operate in parallel without tight coupling, the result is a growing divergence that eventually demands resolution. Silver's industrial demand profile has become increasingly important in recent years due to the global acceleration of electrification, renewable energy infrastructure, and digital technology expansion, all of which rely on silver's unique conductive and thermal properties. And unlike many substitute materials, silver's efficiency in these applications is often irreplaceable at scale without performance trade-offs, which means substitution is not a simple pressure release valve in the system. At the same time, Silver's monetary demand does not diminish simply because industrial demand rises. In fact, it often increases during periods of monetary uncertainty, inflationary pressure, and currency instability because investors historically turn to hard assets when confidence in financial systems weakens, and silver, being more accessible and more volatile than gold, tends to attract asymmetric flows during such phases, which intensifies demand precisely when physical availability is already tightening. This creates a compounding effect where both sides of silver's identity begin to activate simultaneously. Industrial users requiring steady supply regardless of price fluctuations, and investors increasing allocation due to macroeconomic uncertainty. And neither side is easily price sensitive in the short term, meaning that price becomes the pressure absorber rather than the demand regulator. In traditional commodity systems, rising prices typically reduce demand and increase supply, restoring equilibrium. But silver does not respond cleanly to this mechanism because a significant portion of its supply is not driven by silver price incentives, but by the production economics of base metals such as copper, lead, and zinc, where silver is produced as a byproduct, meaning that even if silver prices rise significantly, miners may not increase output unless the primary metal economics justify expansion. This byproduct structure introduces a lag that is critical to understanding the current pressure because it removes the immediate feedback loop between price and production and replaces it with a delayed and indirect response mechanism, which means that even in the presence of strong demand signals, supply cannot adjust quickly enough to prevent tightening conditions in the physical market. Meanwhile, above-ground silver inventories have been steadily drawn down over time through decades of industrial consumption and recycling inefficiencies, and while recycling does contribute to supply, it is not sufficient to offset industrial demand growth during periods of accelerated technological expansion, particularly when silver is used in small quantities across a massive number of devices, making recovery economically and logistically complex. The result is a system where visible liquidity in silver markets does not necessarily reflect actual deliverable physical availability, and this distinction becomes critical when stress emerges because financial participants may assume abundance based on paper contracts, while industrial users and physical holders experience tightening availability. In real terms, this divergence between perceived liquidity and actual liquidity is one of the key drivers of volatility in silver markets, because when confidence in paper claims begins to weaken, even marginal shifts in sentiment can trigger disproportionate moves into physical demand. And given silver's relatively small market size compared to gold, these flows can have amplified price effects. From a monetary perspective, silver's role has always been more volatile than gold's role because silver is more abundant, more industrially useful, and historically more accessible to broader populations, which means it tends to behave as a more sensitive indicator of monetary stress, reacting faster and more aggressively to shifts in liquidity conditions, inflation expectations, and currency confidence. This sensitivity is what creates the perception of instability, but in reality it is a reflection of responsiveness because silver is effectively acting as both a monetary pressure gauge and an industrial supply chain input simultaneously, and when both systems experience stress at the same time, silver becomes the focal point of repricing activity. Another layer of pressure comes from the financial structure of silver trading itself, where large volumes of paper contracts represent claims on metal that may or may not be settled physically. And while this structure provides liquidity under normal conditions, it becomes a source of instability when participants begin to question the ability of the system to deliver physical metal in stressed scenarios. In such conditions, the distinction between settlement and rollover becomes critical because markets can function smoothly as long as contracts are rolled forward indefinitely. But if a significant portion of participants demand physical delivery rather than contract extension, the system must reconcile claims with actual inventory, and if those claims exceed available supply, price must adjust rapidly to ration demand. Silver's relatively small global market size amplifies this dynamic, because even moderate shifts in capital allocation can represent large percentages of available supply, meaning that price discovery becomes highly sensitive to incremental flows. especially when those flows are motivated by fear of scarcity rather than speculative return expectations. On the industrial side, demand is not purely elastic because many applications require silver regardless of price changes, and while some efficiency improvements and substitution efforts exist, they are often slow, costly, or technologically constrained, meaning that short-term demand reduction is limited, and this rigidity adds further pressure to the supply-demand balance. As global industrialization continues to evolve, especially in energy transition technologies, silver's role is not diminishing but expanding in scope, and this expansion is occurring at a time when long-term exploration investment has not kept pace with potential demand growth, creating a forward imbalance where future supply growth may not be sufficient to meet projected consumption requirements without significant price revaluation. From a monetary behavior standpoint, silver also tends to attract retail and institutional interest during periods when gold becomes too expensive or too concentrated as a store of value, which creates cyclical inflows that are often more volatile and speculative in nature, but still contribute to physical demand when investment vehicles require backing or when premiums on physical products rise. This combination of structural industrial consumption, lagging supply response, financial abstraction, and pricing mechanisms, and periodic surges in monetary demand creates a multi-layered pressure system that does not resolve through simple equilibrium adjustments, but instead builds tension over time until price becomes the primary mechanism for resolving all constraints simultaneously. In this environment, silver's price behavior often appears disconnected from traditional valuation models because those models assume stable substitution, responsive supply, and efficient price transmission. But silver operates under conditions where each of these assumptions is partially weakened, resulting in price movements that reflect delayed convergence rather than immediate efficiency. What is increasingly evident is that silver is not simply trading as a commodity or a currency proxy, but as a constrained resource embedded in multiple critical systems at once. And when a single asset becomes essential to both financial confidence and industrial continuity, its valuation begins to reflect not just scarcity in isolation, but systemic dependence across multiple sectors. As these pressures continue to accumulate, the distinction between monetary silver and industrial silver becomes less theoretical and more operational, because in physical markets there is no separation between the two, only available metal and unavailable metal, and when availability tightens, the system must reconcile competing claims in real time through price movement and allocation mechanisms that can appear abrupt. The longer these imbalances persist, the more sensitive the system becomes to marginal changes, meaning that even small shifts in sentiment, policy expectations, or industrial demand forecasts can trigger disproportionate reactions because the underlying structure is operating closer to its functional limits than surface level price stability suggests. At this stage, silver is effectively positioned at the intersection of two accelerating forces, one driven by technological expansion and physical consumption, and the other driven by monetary uncertainty and capital repricing, and both forces are reinforcing rather than offsetting each other, creating a condition where pressure does not dissipate but accumulates across timeframes. And as this accumulation continues, the market begins to behave less like a stable pricing mechanism and more like a tension system awaiting release, where the timing and direction of that release becomes increasingly difficult to predict with conventional tools, and where the distinction between normal volatility and structural